So what we're going to do today is we've had a lot of new lenders coming into the private money club. So I just want to kind of take a step back and talk about some of the different type of deals that are going on right now in the community, what to kind of look for when you first get into private money club, how all this works as far as finding deals and finding borrowers to lend your money to, when to, start to build that relationship and what that looks like. But what I wanted to start with today was just kind of, when you're new to private money club, what do you do? What are some things you need to have in place? What can you, expect as you get going with all this stuff? So all right. When you first come into the private money club, again, you're either going to be a borrower or a lender. Now, I'm going to kind of treat today like you're a lender. The majority of people joining the private money club right now are joining on the lender side. So what the difference is if you come in as a borrower, you're actively doing real estate right now. So you're out there marketing, looking for distressed properties, properties that you can buy at a discount, right? So and that's what people in the real estate game do, is they look for people that a lot of times that are in trouble. So disasters, divorces, distressed properties, things that would cause them to not sell on the regular open market. Now, right now, this market that we're in, with as hot as real estate is, multiple offers, cash offers being accepted, it's tough. It's a tough time to get into real estate investing if you're not already established and having a good network in place as far as marketing, referrals, word of mouth business, people sending you deals, things like that. Those, if you have an established business, those guys are rocking and rolling still right now. And congratulations to them. But if you're new to this, it's a little bit tougher to get in this market because you make money in real estate when you buy. If you don't buy the deal right, you're going to be upside down from the start. You're going to look to cut corners or do things cheaper to be able to make a profit on it. It just creates a mess. So you're always looking to buy low. Buy low, sell high, don't lose money, as Chris always says. And that happens in real estate too. You make money when you buy down here. So you always want to look for the deals, because the whole idea of a flip is to buy down here, put work into the property, and then sell up here, right? So buy low, do work into the property, and sell high. That's the essence of a house flip. I mean, that's really all real estate is. Or if you're doing rental properties, it's all about the money, right? It's all about what you buy it for. What's that going to cost you? How much rent can you bring in? What's the spread? And what's that look like? And then the BRRRR method, you'll hear a lot of investors talk about the BRRRR method. So this is simply buy, renovate, refi, buy, renovate, rent out, and refi. So you're buying the house, you're fixing it up, you're getting it rented out, and then you refi it. Now, the reason for this right here, and you'll see this a lot on private money club deals. So what they do is they use private money. So one of you that's a lender, they use private money to buy. They'll use private money to renovate, or what Devin Burr, if you guys were on this last Wednesday, what he does is he uses hard money. He uses hard money to buy, hard money to renovate, and then private money to cover his carrying costs. So the interest that he's paying to the hard money lenders, he's using private money loans to cover all of that, along with money from his policies. And so that way he's actually using zero money ever out of his pocket. But so there's different ways to do this. And just to kind of make a real quick distinction, the biggest difference in hard money and private money, hard money is going to be like, so we have something called syndicated capital partners that Chris owns and is a partner in. What syndicated capital partners is hard money. So hard money is going to have terms. So what that means is somebody can apply for a syndicated capital partners loan, and then they're going to have to qualify for it. So it's based on their credit score. It's based on what, their set amounts that they have to pay as far as points go, interest goes, how long the terms are, like all of that is set in place. So it's more like dealing with a bank when you come to hard money, except the money typically comes from hedge funds. That's the most common place that hard money comes from, is from hedge funds. And that way it's less regulated than a bank, for instance. So it's a little bit more flexibility. You don't have to be as strong as far as qualifying goes like a bank loan would be. And it's hard money, so it's higher interest, but it's easier to get, okay? But a lot of times it's set terms. Private money is you, me. So somebody that just has money from a self-directed IRA, an infinite banking policy, money sitting in a checking account that they want to lend out and make more money on. And then they go to somebody and say, okay, listen, I'm willing to lend to you, but I want to make 20% of profit, or I want to make 10% annual interest, or I want to do it for 2 years. And then the borrower says, well, I'm willing to pay you this. You can negotiate back and forth, but it's just done between your money and the borrower, and that's it. There's nobody else involved. Where the hard money, again, like syndicated capital partners, set terms, set interest, set qualifications. If you don't qualify, too bad. There's no negotiation, things like that. And it's not true private money. It's coming typically from hedge funds and things like that. So that's the biggest distinction right there. Usually hard money is going to be right in between where private money and bank money is. So bank money, what can you get a bank loan right now? I think we're up around 4%, but let's just say 3.5 to 4% at a bank. Hard money, very common, around 6%. Around 6% is pretty common on hard money. And then private money, like you see on Private Money Club, these are going to be 8 to 15% deals. So bank money is always the cheapest. Hard money is always going to be kind of in the middle, and then private money is always going to be the most expensive. But on the other side of that, the reason why people like Rob on that deal in Georgia, people like Jack use private money is because it's easy. You can close quickly. I mean, we can close on a deal with private money. I can wire you the money same day. It's in your account ready to roll. There's not going through all the paperwork and all the approvals and everything like that bank money and even hard money a lot of times has involved in it. Hard money can be quicker too, but not as quick as private money. So the people are willing to always pay more for the ease of use and the simplicity of private money. And then, so what the BRRRR method takes advantage of is all three of these essentially. So you buy the property with harder private money, you renovate the property with harder private money, then you rent it out. What renting it out does is it seasons the property. And I'll explain that in a second. And then when you go to refi it, so the last step in this is refi. Refi is when you go to the bank to get a long-term loan at a lower interest rate to pay off these higher interest rate loans for the long term, okay? So you'll always see private and hard money used in the short term. You'll always see traditional financing like bank money used in the long term. And this is just leveraging money, okay? That's one of the beautiful things about real estate is you could take $20,000 right now, and the bank will give you $100,000 to go buy a house. So now, instead of having $100,000 in this house, we have $20,000 in this house. And then if we start looking at cash on cash returns, our returns that we're making on this property when you only have 20,000 in it as opposed to 100,000 are much higher. And that's what leveraging is. You're leveraging your credit. You're leveraging that property. You're leveraging other people's money to own and obtain higher priced assets. That's all leveraging is. And that's one of the nice things about real estate is it's very easy to leverage what you currently have and what you're doing into a lot more. But that's the BRRRR method right there. And then Chris always adds a last R onto it, which is repeat. So buy, renovate, rent, refinance, repeat. So in between the renovate or in between the rental and the refi is that seasoning period. And what seasoning is a traditional bank. They're not always going to lend to you on a brand new rental property, for instance. So if I went to the bank, depending on my debt to income ratio, depending on how many other loans I already have for other rental properties, all that stuff goes into this. But at some point, even if you have the best credit in the world and tons of money, at some point the bank is typically going to say, okay, we're not willing to lend you any more money on new rental properties. So if I have a portfolio of all these rental properties, let's say I have 5 of these things, now I'm maxed out, so to say, on the bank giving me new loans on more rental properties. So if I want to buy my 6th property, what I need to do is I need to follow this method using private money and hard money private money and hard money to season the property. And then once this property is seasoned, typically 12 to 18 months is what the bank wants to see. And what I mean by seasoning is there's a renter or a tenant in the house. They're paying rent every month, coming in consistently. They're never late. They're never missing a payment. So what we're basically doing is we're proving that the renter or the tenant in that house is good, that they're going to pay. And this is what's called seasoning the property. And then once the bank sees that the property is seasoned, then the bank is willing at that point to say, okay, our risk is now down because we see that this is a consistent property that's going to have a nice cash flow regularly, right? Because if the bank's going to give you a loan for $1,000 and this is bringing in $1,500 a month, the bank knows that they're protected there as far as the cash goes, and that you're going to have the money. So at that point, a lot of times they're willing to give you a long-term loan then, as opposed to at the very beginning. So that's how you can start using this method to start buying more and more properties. And again, depending on if you're using like a syndicated capital partners or true private money, either way, you're going to want to try and, for the long term, get the lowest interest rate possible. In the short term, it doesn't really matter, but in the long term, that can make a big difference. All right. If you guys have any questions on the BRRRR method or anything that I just scribbled on the board, just throw those in there and I'll answer them. All right, let me just check this real fast. Tuesday PM call that happens. Yeah, Bob, we are doing another Tuesday night. So I'm just going to run through basically the basics of the money multiplier, the infinite banking concept. So the specially designed engineered whole egg policies that we use to be your own bank, become your own banker. I will run through a full presentation tomorrow, Tuesday at 6 p.m. Eastern. It'll be about 90 minutes long. So definitely hop on there. If you don't have the link for it, if we didn't get the email from our team, email me, snaggy@chrisnaugle.com, snaggy@chrisnaugle.com, or reach out to me with whatever email or text me 561-313-6213, and I will send you over the login for tomorrow night. No problem. Hard money and private money. Yeah, so just to repeat that one more time, hard money is typically money that's lent from things like hedge funds or a big pool of money, and it's going to have more qualifications. It's more like a bank approval process. So when you go to the bank, they're going to ask you for all these different documents. They're going to check your credit report. They're going to do everything that they do. And if you don't qualify, then it's just a no, or depending on, some of those things, the rate can be affected, but the rates and the terms are set. Private money, it's up to the lender. So for instance, if I'm the private lender and you come to me and say, hey, I want to borrow $100,000, I decide what hoops I'm going to make you jump through to give you that $100,000. I could say, hey, Bob, you seem like an awesome guy. I can see the house that you want to fix up. It looks cool. F it. I'm feeling risky. Here's the money. Let's do the deal. Sign the promissory note, sign the mortgage, and give you my money, right? Or I could say, I want to see your perfect loan proposal. I want to run credit on you. Listen, I'm willing to do it, but I want 2 points and I want 10% annual. Or I want to do it. I'm not going to charge any points, no annual interest, but I want 30% of the deal profits. So it's completely up to us. So private money, it's a negotiation. It's up to you and the borrower on what that looks like 100%, because it's your money. Private money is your money. So that's the biggest thing. Hard money is more going to be like almost like a bank, but it's more like a hedge fund or somebody that just kind of has like more set terms. All right. So let me just make sure we're doing good here. All right, good questions. Keep putting those questions in and we'll get to them as I take different little breaks. All right, so just looking through the chat box. Listen, I'm not going to get to the chat box today, guys. So if you do have questions, definitely put them in the Q&A. Yeah, and somebody said something about tenants in the chat box. Tenants can definitely be a big deal. So good real estate investors are always looking for good tenants. Like when you own rentals, you're going to kind of know what to look for. And that's one of the reasons, like Dwight Harrison that we had on, and I'll bring Dwight back on here soon as well. But Dwight, one of the things that he does really, really well, and why I love his strategy, is he does a lot of what are called lease options. So a lease option, a lot of times they're giving him a higher down payment up front, or it's somebody that is looking to purchase the home, so they're willing to pay more on a monthly basis towards that property, and that kind of commits them more. So if you have somebody that plans on taking ownership of that house within the next 1 to 3 to 5 years, do you think that they might take better care of that property than somebody that's just off the streets renting it for a year that has no plans of staying even in the area? So there's differences when it comes to what you're renting. Obviously, it has to do with the price of the home, a lot of that stuff as well, but it can make a big difference. And that's why a lot of people will check, ask for references. Like, hey, where's the last 3 places you rented? Like, I need to get letters from those landlords that you didn't tear the house apart, that you paid on time. Maybe we'll check your credit, maybe see what other bills you paid and things like that. So there's a lot that goes into looking for tenants. And if you have a strong investor that knows what they're doing with that, it can make a big difference. So if you're ever lending private money on a long-term deal, 3 to 5 years for a rental property, if you're doing private lending on a rental property, that's stuff to ask the borrower. Like, hey, who is it you're putting in the property? What makes you think they're going to be a good tenant? Because ultimately that can affect the money coming in and obviously the value of the home. I mean, if they rip it apart, that's just more money out of pocket that the investor has to pay. So all right, so back to kind of being new to the private money club. So again, right now we have almost all lenders that are coming into the private money club, which is fine because we have plenty of deals right now. And one of the reasons for that is we have not just been inviting all borrowers into the club. So far, all of the borrowers that have come into the club have gone through, let's call it an interview process with Chris and myself before we say, yes, you're a good candidate to be a borrower, and we want to introduce you to all the lenders in the club. So far, we haven't just opened it up to everybody on the borrower side. On the lender side, if you got 10,000 or more and you want to start investing and learning private money lending, let's do it, right? Because you're going to go through the process. It's kind of step by step. It's easy to do. So if you're brand new to lending, it's not a big deal. We'll help you. We'll show you what to do. And I can go through the steps today, again, of just what to look for. There's some different videos on there that you can look for and things like that as well. So when it comes to being new as a lender, there's certain things that you're going to want to do when you first get into the money club. So number one, you're going to want to look through and double check everything. Or you're going to want to go through and set up your profile, set how much money you're looking to lend. Do you have the money right now or is it coming up? And then if you're new to lending, I would recommend setting up a call with me. Hop on my calendar and let's talk about what you're looking to accomplish. Are you looking for short-term loans, long-term loans? What's that look like for you? And let's talk about some of the different deals and stuff like that. But some things you can do on your own, set up your profile, set up your picture, maybe hop on there and look at some of the deals that are posted. Send a message to some of the borrowers. Say, hey, I'm new to the private money club. I have $100,000. I have $20,000. I have a couple $100,000, whatever it is I'm looking to lend. I'd love to talk with you and learn more about you and your company and what you're doing. So start building those relationships. So let me start writing some of this stuff down here. So lenders, one. Let's see. Create profile. You should also introduce yourself. There is a messaging system on privatemoneyclub.com. However, we are also now integrating Slack, the Slack channel, back into it. So definitely hop on Slack. And if you've been on the Private Money Club and haven't been on Slack yet, reach out to us and I'll have Gail set you up on Slack as well. And she'll get you your login and everything. But it's almost easier on Slack right now to communicate with the whole group. So we're kind of going back to Slack to do some of the communications. So go on there and introduce yourself. Say, hey, I'm new to the club. This is what I'm looking to do. I'm experienced, or I'm new, or whatever the case might be. And just tell a little bit about yourself, because remember, at the end of the day, the private money club is about relationships. Business is about relationships. Lending money is about relationships too. And I'll get to more on that side in just a second. So it's important to start building that relationship, introducing yourself, and start talking and meeting with the different members. All right. And then from there, find deals. So once you introduce yourself, you're going to go and start looking for deals. So again, I'm happy to help with this at the beginning. And as you start rolling and talking with other people, start to learn how you use. So how do you find deals? How do you find deals? And then, of course, once you find the deal, you simply lend the money. And then number 5, money incoming. So if it's, interest payments monthly or whatever the terms are, you'll have money coming in. And then number 6 is, of course, repeat. So those are the steps. But let me show you what I'm talking about here. All right. So first off, what we need to decide is, okay, how much money do we have to lend? Okay, because that is going to make a difference. So determine how much you have. If you have $20,000 and there's a minimum $50,000 on a fund or something like that, you know that you're not going to be able to do that. So we can eliminate that as a route forward. So depending on how much money you have to lend is going to help us decide what the best types of deals for you to look at. Now, just because you have $10,000 or $20,000 and you see a deal that's maybe $250,000, that doesn't mean you're out of it. So we do this all the time. For instance, with Chris Rude's deals. Chris Rude's deals are a lot of times between $200,000 and $300,000. So what we'll do is we'll take a bunch of different, people, and we'll put them together into one deal. So what this would look like is, let's say we had a Rude deal and he needs $200,000 for it. Okay, $200,000 is what he's raising for this deal. This is 3 to 4 months, and I'm sure a lot of you guys have went to Chris Rude deals if you're on here right now. But if you haven't, Chris Rude is one of our experienced investors on the Private Money Club. We've known him a long time. He does a lot of mobile home parks. He also does a lot of flips. Just a very, very, very powerful and strong real estate investor. So most of his single family deals like this are 3 to 4 months, meaning you lend your money, you're going to get interest for a couple months, and then you're going to get the principal back in about 3 to 4 months. But nonetheless, a lot of times he'll raise in the $200,000 range. So what would happen is, let's say we had 4 people that had $25,000 each, and then one person had $100,000. Okay, so that equals $200,000 for this deal. Now, all 5 of these people on here are going to be in first lien position on mortgage. Okay, on the mortgage or the deed, on the promissory note. So all 5 of these people are going to be in the first lien position. However, their rights to it are going to be proportional. So these guys are going to have, what would that equal out to be? 12.5% each. Is that right? And then this guy will have 50%. So 12.5% ownership each. The ones with 25,000 in, and then the one with the guy or gal with $100,000 in, the company with $100,000 in, will have 50%. And all that means is, if something was to happen and the property needed to be foreclosed on, and the first lien position rights, exercised, then essentially, whenever they took that back over, this is how the ownership would look: 50%, and then these guys would be 12.5%. And then they can decide, does this guy want to buy these guys out? Do they want to resell the property together? Whatever they want to do with it. But that's what that would look like, just so you know. But the nice thing about being able to do this is, if you don't have a full $200,000, but you want to get in on a deal like this, you're still able to. And Chris Naugle does this all the time for our members. So if you're in the Private Money Club and you're looking at lending on a deal like this, and now the Chris Rude deals do go on the Private Money Club, but they're usually funded before we even get them up there. So again, that's where it goes back to introducing yourself on there. Let us know how much money you're working with. Let us know when that money's available, and then let me know, because if I hear that a Chris Root deal is coming up in 2 days, for instance, boom, I can say, hey, I just saw it. I think this would be great. Check it out. If you like it, then we can put you onto it, in a proportional manner, or even better, finance the whole thing. But that's how that part works, nonetheless. All right. And then the other, so that's going to be a private flip. And we'll talk about some of these different types of deals that are on here as well. All right, so that's going to be a individual, let's call it an individual deal, okay? So that's somebody like Dwight. Those of you that are in the private money club, you'll know these names. Dwight. That's somebody like Chris Rood. That's somebody like Steve Lawson. Who else has been on the club? Michael, I'm just trying to think of the last few deals I've seen get funded. Michael Curse. So these are guys, Dwight Harrison. So these are guys, and actually all guys right now. Where's all my women flippers? Come on, ladies. But we need some ladies in here borrowing money on deals. I know my good friends Noah and Christy. I'm speaking at their event. Christy does a lot of this stuff. They're married though; they do a lot together. But I need to get some active investors on here. Marine, you borrowing money? We need to get you in here and borrow some money. All right. So these are what I call individual deals that you can lend to. So these are, people that have their, companies, whether it's an LLC, small little S corps, whatever it is, and they're out there doing flips, right? They have teams in place. Dwight's doing about 120 deals a year. So they're doing about 10 to 12 a month right now. Chris Rood's doing, I would say he's probably knocking out 3 to 4 a month right now. Steve Lawson was doing about 3 to 4 a month. Michael Curse is doing maybe, I don't know, a couple a year, I think, right now. So, anything in between is what that looks like. And then we have what are called funds. So these are the two most common things you're going to see on the private money club when it comes to lending. And then we can talk a little bit how this breaks down. But so funds, the one that we had recently that just closed down was the Safari Fund. Okay, some of you guys might have gotten into this. I saw a couple of people commenting earlier that I know are in there. So what Safari Fund was, it's a private fund that Chris Naugle is a partner on, and it had 1 to 3 year term options. Okay, so as an example, 1 year would have paid 6%. 2 years would have paid 9%. 3 years paid 12%. So if you decided you want to lend your money to the Safari Fund for 1 year, it would have paid you monthly interest payments of 6% annual. So 6% annual paid monthly. If you were to commit to 2 years, it would pay you 9% a year monthly interest payments. And if you were to commit to 3 years, it would pay you 12% each year, monthly interest payments. And at the end of the 1 or 2 or 3 year term, you would get all of your principal investment back. The Safari Fund was built specifically to fund mobile home parks. Okay, so I mentioned Chris Rood before. Chris Rood does a lot of single family flips. Chris Rood also loves mobile home parks. If you've been on our 3-day trainings before, you've seen him come on. He wears his make mobile home parks great again hat, right? And he's all about it. He's all in on this stuff. So he does a great job finding properties, evaluating them, getting them under contract, purchasing them, bringing in new trailers, building the infrastructure, and getting them fully rented out and creating income with them. So he's very, very good at that. So Chris Root started doing this. And then Chris Naugle said, well, the only way to scale this business and do more of it is to have more money. So they teamed up and created the Safari Fund. And the Safari Fund is funding mobile home parks that Chris Root and his team are out there purchasing. So just as an example, that's how a private fund works. So the private fund, I believe the Safari Fund had a $50,000 minimum. and I believe you had to be accredited. So there's some qualifications when it comes to private funds. So there's set terms. You're not a first lien position on a specific property, but the Safari fund, when it funds the deals, becomes first lien position on those deals. So the way it's done is a little bit differently than being a direct first lien position like over on these individual deals. So these private funds are always going to be, you always want to check if they're what's called SEC registered. So you can make sure that they're registered with the SEC. That's one of the ways to make sure that it's legitimate. Okay. And then another type of fund is like the Georgia deal that we just have been talking about. So this is Rob. Again, he'll be on Thursday night. But this Georgia deal, and I know a lot of you saw this. I think it's full. If not, I can email it to you if you're in the Private Money Club. Send me an email and I'll send you over all the PDF. I was actually going to pull it up today, but again, I'm on my phone, so I'm not able to share my screen. And actually, my new systems, it says it's complete now. So we'll be back in action here this afternoon. But for right now, if you haven't seen the Georgia deal and you're interested in it, just shoot me an email and I'll send you over all the information packet with the brochures and all the details and all that stuff. But what this was, 18 months, 12% annual, monthly interest paid, and then return at the end of the 18 months, return of your investment. I believe it had a $50,000 minimum as well. $50,000 or $100,000 minimum on this one. I don't exactly remember. And that was pretty straightforward. Again, that actually was a first lien position on this property. This was a residential neighborhood development that they're doing. And it was already fully sold out, actually. So they already had sold all the properties. It was just a matter of going in and building them and getting the certificates of occupancy. All right, so that's another type of larger project, not necessarily a private fund, but more of a larger project. And then Chris has another private fund coming out very similar to Safari that's lending on commercial deals. That should be available the beginning of March. So if you like the idea of these private funds, and then that one's going to go anywhere from, I believe, 6 to 10 or 12% as well. I don't remember exactly what the interest rates are on the new one. So that one's coming up the beginning of March. So, and again, you can do, up to 3 years. So if you're looking for a longer term investment, that could be, those private funds could be a good way. Because the one thing sometimes when you run into on some of these quick flips over here is 3 to 4 months return, from when it's start to finish. Because think about this. If you're going to make 12%, but you get your money back in 3 months, and then it takes a month to find the next deal, now you're 4 months in, then you lend your money, another 3-month deal, another month to find another deal. So now so that's another 4 months. And let's say we go through this process again, 3 months, and then another month. So in 1 year, you had your money lent out for 3, 6, 9 months out of the 12 months. But you're only getting paid interest when your money's lent out. So all of a sudden, the 12% you were making on your money really is 9% annual, because you're dealing with dead time. You're dealing with that 1 month where the money is in between deals, from when it's going from the end of one deal when you're paid back into the beginning of the next deal when it's closed and ready to go. Now, if you're with a really strong investor, a lot of times they can lower this. So as this project finishes, they literally have another one that's ready to close within a week. So that way, instead of a month, maybe you only have 1 week you're waiting. So then we can, get closer to the 12% returns. And again, that goes back to what I'm going to finish this with, which is building relationships and why that's so very important. Because if you lend your money to Dwight and things go well, or let's say Chris Rude, and things go well, and he's got another deal coming. So this one's now done, but he's got another one. Well, is he going to go back to the Private Money Club to find a new investor? Or is he going to say, okay, we just did this deal together. Let's just take this money and roll it into this deal and make you that offer. And if you like the way things went on this first time, then of course you're going to say, okay, let's just roll it to the second deal. And if he's really rolling with it, again, instead of a month lead time, it might only be a week lead time. So that way your money's not sitting, your money's moving and making more money at all times. So just things to think about when you're looking at deals, when you're thinking about, do you want to lend long-term, short-term, and what that looks like. All right. And then there are private deals, you know, the individual deals over here, people like Dwight, people like Michael Kurz. And there's some other ones, I'm trying to think. But they also have available long-term deals. So Dwight right now has these little rentals that he's doing, these little lease options that you can finance for 5 years. And he's actually amortizationing. He's doing an amortized loan on the repayments. You're actually getting back interest and principal during that 5-year time span, which is kind of nice because you're getting your money back so you can start using it again right away. So there are some other things like that that are going on as well for longer term. So you just got to keep an eye open for. Again, it goes back to where are you starting. All right. So when you are new to Private Money Club and being a lender, again, go in there, think to yourself, do I want short-term? Do I want long-term? Do I want to work with individual investors, or do I want to just put my money in a fund? The other difference in an individual and a fund is these individual investors, I mean, if it's like, you know, some of these experienced guys I just talked about, they're going to have the mortgage documents, the escrow company, the promissory notes. They're going to have all that set up and ready to roll because they do it multiple times every single month. They just take documents, they can send them over. If you want to double check them, have an attorney look at it, nothing wrong with that. But they're going to give you the documents ready to go. If it's a newer borrower you're lending to, you guys might have to create the promissory note and the mortgage and things like that. So a little bit more work involved. When it comes to the private funds, those are set documents. So those documents have already been approved by attorneys. Those are the ones that have to be used. So you don't have to think about it. Just they're given to you, you read them, you sign them, and you do the deal. So it becomes a little bit easier there. But those are some of the different things to look for. Let me hit these questions real fast before I move on. All right, Dwight's info up. Yeah, if you guys just email me if you need anything. I'm not able to post anything right now because I'm on my cell phone. Is a private lender, is it good to have an LLC and run everything through that? And what are the benefits of getting an LLC? So first off, when you're lending money, always lend only to an entity. Okay, and preferably send it to an escrow or an attorney where the money's held in escrow until the deal closes, and then it goes through that way. But only lend to an entity, never lend to an individual. That's because of Dodd-Frank laws. Now, when you're lending though, as the lender, you can lend from your personal side, or you can create an LLC and lend from the business. It's up to you. And really, it kind of boils down more to your tax situation and how much lending are you doing. So if you're lending to like a private fund and the money's going to sit out for 3 years and you're not even going to think about it, and then you just get it back in 3 years, and do it again, there's not going to be a whole lot of active work being done. So there's not a lot of tax benefits and tax write-offs and things like that. But if you're out there constantly doing new loans and making this an actual business where you're out networking and you're traveling places, meeting people and seeing deals, and you're doing all this stuff, then it might make sense to create a company out of it because there's going to be a lot of tax deductions probably that you're going to be able to take. But that's more of a question. Sit down with your accountant, or if you need somebody good, get a hold of like Corporate Capital, Brent Carlson and his team. I can give you that contact information or referral if you want to chat with them. But it's going to be more of that situation. So just think about what you're doing, and that'll kind of help decide should you use a business or not. All right. In a lot of the onboarding docs, there's info about the Slack account. Is that still being used at all? Yeah, so we actually, we went away from using the Slack account, and now we're back to it just because we were having trouble with our internal messaging system on the Private Money Club website. So we are going back to Slack for the mass messaging aspect of it. So they're going to work together for the next few months until our new Private Money Club is ready. And again, if you've missed the last couple episodes, we have hired a development team to completely build Private Money Club from the ground up. So it's going to be all new software and website, as well as an app for your iPhone and Android, and everything will be perfect. So in the next, I don't know, it's probably gonna be 4 to 5 months till that's finished, but that's where we'll be in about 4 to 5 months. In the meantime, yes, let's keep using the Slack channel, especially for messaging. Let's see. I doubt it's been an issue yet with Private Money Club, but I might as well ask. With scammers being everywhere else, what's in place in the Private Money Club to protect lenders and borrowers from overseas scammers? Yeah, that's a good question, Eve. I mean, you're only going to lend your money to somebody that you know and you trust. So that's going to be kind of building that relationship. And we're going to talk more about that. And that's going to be making sure that the contract and the promissory note that you're signing are legitimate, that it's a piece of property that's legitimate. And there's ways to check that if you're unaware of the person or it's somebody new that you're working with. And then additionally, on top of all of that, I don't know, somebody overseas. I mean, again, only lend your money to a legitimate attorney or closing agent, escrow place, escrow agent. You're always going to call directly and verify the wiring information 2 or 3 times. So always double and triple check the wire information. Never get wire information from an email. Always get wire information over the phone, on a live person multiple times. So follow all of those steps and it won't be an issue. If a foreclosure takes place, how does the process work? What are the costs and who are the players? So it depends on what state you're in, Craig, on how the foreclosure works. But an attorney can help with that. And, it happens, but it's one of those things that we have to deal with. I mean, so the costs are going to vary, but typically that's why you're always going to want to make sure when you're lending your money, make sure that, if you're lending and something does go wrong, what is the collateral that's backing that money, right? So let me just show you what I mean by that. So if we lend our money, okay, this house right here, this is my little house, right? So let's say this house is worth $100,000. Let's say it needs $40,000. Okay, this is the purchase price. Let's say it needs $40,000 in rehab. And then let's say that it's a $220,000 ARV. ARV is after repair value or after rehab value. So what the market value of the house is after the repairs have been done. So in this case right here, if they were buying it for $100,000, they needed $40,000 in rehab to be worth $220,000. It can give us an idea of how much are we willing to loan. So if we're willing to lend on the entire $140,000, we know it's going to be worth $220,000. Maybe we say, okay, well, we'll give you $100,000 at first to purchase the property, and then we're going to give you $10,000 at checkpoints. Okay. So excuse me. I just have a call coming in. Oh, my phone's dying too. I'm plugging this thing in. Okay. All right. So what we do is we can do this in arrears too. So if maybe we give them $100,000 to purchase the property, and then we say, okay, so I'll give you another $10,000 up to $40,000 for the repairs that you need, but I want proof along the way of what's going on. So maybe the house needs $10,000 in paint and floors and windows, right? So you say, okay, I'll give you $10,000 for that. And then I want to have proof, whether I hire somebody to go look at it, whether we do a FaceTime call, whether we do pictures, whatever it is, that this has been done. And then once that's done, maybe it needs $20,000 for a roof, right? You say, okay, now that this is done, now I'll give you the next $20,000 for the roof. And then once that's done, maybe it needs $10,000 in, appliances or whatever, a kitchen, whatever. And you say, okay, now that that's done. Now I'll give you the last $20,000. And then that way you're only giving them your money as you know that if something went wrong, you're able to foreclose, take that property, and your money's still protected by a higher asset. Because at the end of the day, if they walk away and you've given them $130,000, but the thing's worth $220,000, you got a nice spread in there where if you have $10,000 in foreclosure, attorney fees and whatnot, you still have plenty of money there where you can take the property and wholesale it And the goal is to break even, or at least get back the interest you thought you were going to earn. But in a lot of cases in that scenario, you are able to wholesale the deal or flip it yourself or whatever the case is and make even more money than what you would have. Yeah, it becomes a little active. So you want the better case in that case, if you don't want to be active at all, just passive, just wholesale it to somebody. And if you ever get in that situation, that's when you reach out to all these investors in the club. Say, hey, I just had to foreclose. Who wants this thing? Like, I'm not an active investor. Who wants it? And I guarantee you, one of our borrowers in the club will jump all over that thing. So that's how you want to always protect yourself. All right, so let's see here. Okay. Great question though, Craig. What's the cost to be a member? It's $997 a year. Comes with the 2-hour group coaching and everything. I apologize. If you lend $50,000 at 12%, you would get $6,000 per month. No, so let's do the math on it. So $50,000 at 12%. Okay. So easiest way to do this is look at $100,000. So $100,000 at 12% is $1,000 a month. Okay, or it's $12,000 a year. I'm sorry. Sure, I did that. 12%. So what's 12% of $100,000? $12,000, right? So same thing. What's 12% of $50,000? You do the math. 50,000 times 0.12. Okay. So 50,000. So if you do 50,000 times 0.12, 12%, it should give you 6,000. So that's annual though. Annual. So it's 12% annual. 12% annual interest. What interest paid monthly means is the annual total. Annual total is broken out monthly and it's paid to you monthly. So if you're going to earn $12,000 over the year on 100 grand, divide that by 12 months. There's 12 months in a year. So divide 12 by 12,000. That's $1,000 a month. Same thing over here. If we take $6,000, which is this math, and we divide it by 12 months, that equals $500 a month. Okay. So $500 a month. So what this would look like, let's say this is a 3-year deal. You lent them $50,000. You're going to get $500 a month in every single month for the next 3 years of your life for doing nothing. You should have a $500 check show up in your mailbox every single month. And then at the end of the 3 years, you're going to get one final check back for $50,000. Okay. That's called an interest-only loan. That's the most common type of lending that you're going to do in the private money club, whether it's a fund or whether it's a deal. Now, there are some creative ways to do this too. So sometimes you'll see some different things. I mentioned it with Dwight a minute ago when it came to that he does an amortized loan for these 5-year rental properties that he's doing. So what that looks like is if you were to lend $100,000 for 5 years at 10%. Okay, that's what that looks like. However, instead of getting $830 a month back in interest-only payments, what Dwight's doing on these 5-year rental deals, rental-back deals, is he's paying principal and interest. This is called an amortized loan. Okay. So an amortized loan is just like what the bank does with a mortgage. So if you go buy a home, your mortgage is on an amortized loan. Okay. The majority of interest on an amortized loan is paid up front in the first, on a 30-year mortgage, the 90-some% of interest is paid in the first 7 years. So it's like that in any amortized loans. The majority of interest is always paid way up front. So in this case, the majority of your interest is being paid up front, but instead of only the $833 a month coming in, I'd have to run an amortization schedule. I don't know exactly what it is, but it's going to be something like, let's say $1,200 a month coming in. So you're getting more money monthly, but at the end of the 5 years, instead of getting back $100,000, because your principal is being returned during that time, your final balloon payment at the end of the 5 years might be $40,000 because you recoup that other $60,000 over those 5 years. And so what they do is they run an amortization schedule and it shows you exactly what that money is. So the good news is on that is your total money's not out the entire time. You're getting it back and you can get it and redeploy it into the next deal even quicker. So it's just a different way of setting it up. But I like it a lot. And when Dwight was on, we kind of went through some of the pros and cons on that. So you can go back and watch that episode on the Private Money Club, the couple of episodes that I do with Dwight so far. And again, I'll bring him back on soon. Those deals are going really well too. If any of you guys watch those, they've been killing it with those things. So definitely give Dwight a shout if you want to get involved in something a little bit longer term and get a little bit more money back like that. And those you can get in like $10,000, $15,000. He's doing some real low price points on some of those. So what's cool about that is if you have 15,000, you can get in one of those. If you have 100,000, you can get into, how many is that? 15, 30, 45, 60, 75, 90. You can get in almost 7 of those. So why would you want to get into 7 properties as opposed to just one at 100,000? Diversification, right? Why have all your eggs in one basket? We can have all your eggs in 7 baskets. That way, if one goes wrong, you don't have to deal with all of your money being, it's only a little tiny portion of it. So there's different reasons why too, to spread your money around to different deals. All right, just double check. We don't have any funds that invest in tax liens, but we do have, I guess we don't have any tax liens on there. No, we don't have anything in tax liens right now in Private Money Club, Craig. All right, Denise, hopefully that answered your question, difference between interest only and getting the principal back. All right. All right. And I know we're getting past the end of the hour here, so I'm going to start to wrap things up. But the last thing that I wanted to mention, so you go in, you introduce to figure out how much money, short-term, long-term, that's going to help us decide what type of deals, how much money do you have to lend, so we can find out, do we need to deal with, minimums that have 10,000, minimums that have 50, minimums that have 100, do we want to spread it out between different deals? So we need all that stuff up front. And then once we decide the type of property, the type of deal that you want to fund, then we need to start looking at who are you going to lend your money to? And that's where the relationships come into play. So this is where you're going to say, okay, I know I want to lend my money short term. I know I have $100,000 I want to lend. Now let me find who I want to lend to, right? So that's when you're going to say, okay, let me meet with Jack Petrick. Let me meet with Dwight Harrison. Let me meet with Herson. Let me meet with Andrew. Let me meet with Steve Lawson. Let me meet with some of these different borrowers, Rob with the Georgia deal, and let me talk with them. Okay, you're going to start building the relationship. Okay, because think about this. So before Private Money Club existed, to find these kinds of deals, you would need to go to masterminds, RIA meetings, local networking groups, and find investors that are looking for private money and develop that relationship yourselves. Okay. One of the nice things about Private Money Club is maybe you don't know Jack, maybe you don't know Rob, maybe you don't know Dwight, maybe you don't know who any of these people are, but maybe you have been, following what we do with Money Multiplier now for the last 6 months or the last year, or maybe you've hopped on our 3-day money school trainings, or maybe we've met at past events, something like that. So you have myself, you have Chris, you have our team, and we're watching over this thing the entire time. So again, when I introduce you to some of these different borrowers, you might not know them, but you know me. And guess what? I've known them for several years and I've done business with them and I trust them. So yes, you still want to do your own homework. Yes, you still want to do your own risk assessment. Yes, you still want to build your own relationship. But doesn't it feel good to kind of have that reference? Somebody telling you, hey, I've done business with them. Hey, I know their history. I know their background. I know what they've done on past deals. I know how they've treated past investors. I love them. So why don't you have a chat with them and see if you like them too? It's a lot better than just going on some random website, finding some random dealing, somebody with somebody that you've never met in your entire life, or going and trying to find somebody on your own in person. And that's what the private money club's all about, are these relationships. Because at the end of the day, can you do all this stuff on your own? Absolutely. It's not hard to get an attorney to look over the contracts for you. It's not hard to know the steps, right? Only lend to a business. Make sure you're listed as additional insured on a property. Make sure that you're covered by the collateral in first lien position. If something goes wrong, you're able to recoup your money. Make sure you're only sending your money to an entity and to an escrow company that the property's going to close. Make sure that you're doing all these steps and everything's done properly. But at the end of the day, it's not hard. And then once you build that relationship, again, you can just start flowing the money, deal after deal after deal after deal. And that's the hardest part about a private money lender, is that day that they come to you and say, hey, here's your money back, because now you got to go find that next deal. But if you have the relationships in place and you know that the money's coming back, if you know that that Chris Rude deal is done and you're going to get your money back in 3 weeks, well, guess what you better be doing? You better be hopping on the phone and saying, hey, Jack, I lent you money last year. Hey, Jack, we talked last year, but I didn't lend you money, but now I want to lend you money now. And you see these people on Money Club Mondays. You see them on our group coaching calls. You see them in the private money club, and you build these relationships. And this is how you start creating what we call consistent, predictable, income. Consistent, predictable income for the rest of your life. And you hear us talk a lot about that, because that's what private money lending, that's what the private money club at the end of the day is for and does, is it gives you a resource to find people that you can trust and build relationships with, to lend your money and create consistent, predictable income for the rest of your life. And why do we say this? Because, for instance, the stock market does what? It goes up, it goes down, and it goes level, and we never know if it's going to be up or down when we need the money. Maybe over the last 12 years, you don't care if the market goes all kinds of volatility. At the end of the day, if as long as it's up, when you retire, you're happy. But what if you've been riding this roller coaster the last 12 years, and now you're at retirement 12 months from now, but 3 months from now, the stock market takes a shit, and all of a sudden that money's down, and your 401k now drops in half. And all of a sudden, what you were planning on retiring is now down here. And now the money you were planning on drawing out of there, you're not able to draw all that out of there because it's going to run out of money before you pass away. So you can't do that. So you need to lower the amount of money you're drawing from it. Or you got to plan, hey, I'm only going to be able to live for 10 years. I have to go back to work, or whatever the case is. By doing these deals, we control every aspect of it. So if we know how much money we need, we can do it backwards. If I know I need $100,000 a year to live on, well, let me save $1 million. Let me plan on lending that money at 12%, and let me start collecting $120,000 a year, which is $10K a month coming in. So can you live on $10K a month in retirement? If you can, then you know you need to start with $1 million at the beginning of this. If you need more, let's reverse engineer it. But it allows us to create consistent, predictable income when we need it most. And for me, that's one of the best things that I love about Private Money Club. And those are the stories that we have coming in right now. Those are the testimonials that people are emailing us saying, man, we thought we were gonna have to go back to work. We've implemented what you guys have taught us between the infinite banking concept, between our self-directed IRAs, and between lending money. And now we don't have to go back to work. We've created enough income for ourselves in retirement that we're good to go. And thank you guys so much. And we're starting to get a lot of those testimonials and emails coming in. So you sent one of those. Thank you so much. We're so happy we were able to help you. If you haven't got started, or you're working that way, this is what this is all for. So one more time, relationships are where it's all at. Start with the relationship with me and Chris. So if you haven't yet, or you're at a point where you're ready to start lending money, let's hop on the phone. Let's talk through it. Let's make sure you're doing things right. And let's get you guys rocking and rolling. So with that being said, appreciate you all dealing with my bootleg little setup today on my phone. I hope everything looks fine. It looks like my new setup is ready to go. So I'll get that fixed now, be ready to go for the rest of the week. But we are doing a presentation. I am doing a base presentation tomorrow at 6 p.m. Eastern. Wednesday, we have all of our normal shows, WTF, at 9:30 in the morning Eastern. wealth webinar at 1 o'clock Eastern. Ask me anything at 4:30, and then 4:30 Eastern. And then Thursday night this week is the 2-hour coaching call. So make sure you hop on there. It's gonna be really good. Like I said, Rob and Jack are gonna be joining us. We're gonna get deep into what the markets are doing, what real estate's doing right now, and how we can make sure we're being smart about lending our money.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.